Hello friends, welcome to my YouTube channel at One Raj Kamal. As you go through this video, please do subscribe and click the bell icon so that you can get regular updates on new videos as they are put on this channel. Markets this week were a two-part story, flattish for the first 4 days and then collapsed dramatically on Friday as Jay Powell made his Jackson Hole speech. Friday in particular was a terrible day for markets where Dow Jones fell by over 1,000 points and nasdaq by nearly 500 points. Specifically in percentage terms, Dow Jones was down 3.03% on Friday, S&P 500 was down 3.37%, and nasdaq was down 3.94%. Crypto markets also caught the mood, and in the last 24 hours, Bitcoin is down 5.8%, ETH is down 9.2%, Solana down 7.4%, Matic down 3.7%, and Avalanche down 8%. So what happened at Jackson Hole? Well, Fed Chair Jay Powell's annual policy speech at Jackson Hole was perceived as reiterating the Fed's hawkish monetary policy stance. Specifically, Powell said that the Fed couldn't be swayed by data for 1 to 2 months and that they are purposefully moving the policy stance to a level that will be sufficiently restrictive to return inflation back to 2%. He referenced the 1970s when a failure to act in time led to persistent inflation that required the Fed under Paul Volcker to pursue a lengthy period of restrictive monetary policy to get the inflation genie back in the bottle. Also, interestingly, to avoid any confusion, he prefaced his remarks by saying that he was going to be direct. And during his remarks, he made comments such as, there will be some pain to the US economy, and that historical record cautions strongly against prematurely loosening policy. Effectively, some market watchers saw Powell clearly addressing those in the markets who have been talking about the Fed pivot and a potential rate reduction path. As you can see, markets collapsed on Friday in response to Powell's speech. So much for Jackson Hole. Moving ahead, I do want to talk about earnings. With nearly 95% of S&P 500 companies having reported their Q2 earnings, it's important to see at what we have witnessed. While most people seem to imply that earnings were not as bad as expected, the numbers actually tell something very different, and that earnings reflect the tough economic conditions. See this chart for EPS. The EPS expectations for S&P 500 companies for Q2 have come down to $47.25 from $55.01 that was the expectation on 30th June, a reduction of 14.11%. I had shown the same chart in my podcast on August 5, and at that point in time, this number was $52.69, implying a reduction of only 4.22%. Effectively, in the last 3 weeks, the EPS expectations for Q2 have declined by over 10%. And this reflects in forward estimates as well. So EPS expectations for the full year 2022 is now at $210.56, implying a reduction of 6.03% from June 30. In my podcast on August 5, this number was at $216.88, implying a reduction of only 3.2%. Effectively, the decline expected in the full year 2022 EPS for S&P 500 companies from June 30 numbers has doubled in the last 3 weeks. What's happening on sales growth? Well, as you can see on this chart, sales growth for S&P 500 companies grew 15.1% year on year in nominal terms. But this is misleading because soaring inflation that has largely been passed on to the consumers is driving up top line numbers. So it's important to take out the impact of inflation. And if you take that out, as you can see on this chart, real sales grew only 6.5%. But this growth again only came from energy, which has grown real sales by 68.3%. So ex-energy, real sales grew by only 0.9% across the board. That's not very impressive. For comparison, the real sales growth over the last 9 years from 2010 to 2019 was 2.5%, which is 4.3% nominal sales growth less 1.8% inflation. So on a truly comparative basis, sales growth are slowing down ex-energy in line with the decline in demand in the economy. Another picture of operating margins. Operating margins are total revenues less cost of goods sold and any other sales and general expenses that are attributable to operating the business. These margins for S&P 500 companies were 10.13% from 2015 to 2019. Now, COVID was a black swan event where operating margins initially collapsed due to the lockdowns, but then jumped up and reached a high of 13.54% in June 2021. That possibly reflected excessive liquidity in the economy that enabled corporates to not only pass on the increased costs due to supply chain disruptions, but also improve their margins. Now, these operating margins stayed flat till December 2021, but since then have come down dramatically in the last 2 quarters, as you can see on this chart, and are now at a low of 10.95%, a reduction of nearly 245 basis points in the last 2 quarters. And this possibly reflects the fact that as liquidity dries up and demand comes down due to high inflation, corporates are no longer able to charge the surplus that they could do during the post-COVID liquidity glut. Overall, I think that economic conditions are worsening as reflected in economic reports. The Fed is unwavering on its tight monetary policy stance, and markets, therefore, are likely to be in a state of choppiness for the next few months. Thank you.